All right, let's dive right in. Today, we're talking about a true giant, KKR. Now, I know what you're thinking. Old school, high-risk buyouts, right? But here's the thing. The KKR of today, it's a totally different animal. And its stock is telling a story that, honestly, every single investor needs to get their head around. So yeah, you definitely know the name KKR. It's been a titan in finance forever. But let's be real. For us, as public market investors, the big question is, do we really know the stock? Because the company has changed big time, and the investment case today is, well, it's a whole new ballgame.
And that right there is the key takeaway, the whole reason we're doing this deep dive. The KKR that practically invented the risky leverage buyout has quietly transformed itself. We're talking about a shift from that risky pioneer to a much more stable, diversified financial powerhouse. Seriously, this is not the KKR you read about in the history books.
So let's get into it. We're going to break down this modern investment case piece by piece. You're about to see the powerful new machine they've really built under the hood.
Okay, first section, KKR beyond the buyout. Let's see just how far they've come from their roots.
You know, this timeline really tells you everything you need to know. It starts back in '76 as the original, leveraged buyout shop. But the real game changers for us as investors, look at 2018. That's when it converted to a C Corp, meaning anyone could buy the stock, just like Apple or Google. Then, boom, 2024, the full acquisition of Global Atlantic. That move cemented its massive insurance strategy and really poured fuel on the fire, leading to the giant scale we see today.
All right, so how does KKR actually make money now? Well, you have to get your head around their two-engine model. Seriously, this is the key to understanding the entire company. So, picture this. Engine number one is what I call the fee machine. It's the super stable, super predictable part of the business. It just manages other people's money and collects these steady, recurring management fees, month after month. Then you've got engine number two, the compounding machine. This is totally different. This is where KKR invests its own balance sheet, its own cash, to grow and compound capital directly. Think of it like a mini Berkshire Hathaway. And the magic is how these two engines work together. It's a really powerful hybrid.
Okay, so when we talk about that fee machine, the one metric you absolutely have to know is fee-related earnings, or FRE. Just think of it as the pure, clean, reliable profit they make from those management fees. And that record number in Q2, that shows you just how powerful and, maybe more importantly, how predictable that engine has become.
Now, on the flip side, you've got carried interest. This is the classic, high-octane stuff. It's the big payday KKR gets, their cut of the profits, when they successfully sell off a company. The upside can be absolutely massive, but, and this is a big but, it's super lumpy and unpredictable. It all depends on having a hot market for deals and IPOs, which you can't always count on. So we've got the two engines, right? The steady one and the high-octane one. Now let's talk about the fuel KXR is pumping into this machine. Because frankly, this is where the story gets really interesting. Just look at this chart. Almost half, 42% of KKR's massive pile of assets is now what they call perpetual capital. What does that mean? It's money that doesn't have an expiration date. It comes from their insurance arm, from evergreen funds. It's long-term, super sticky capital. And this isn't just a small change. It fundamentally transforms the business model, making their earnings way less volatile and way more predictable. And get this is the real kicker. That 42% of assets, it's generating a full 50% of their fee-paying AUM, so it's totally punching above its weight. The bottom line for us as investors is simple. This new, stable capital is more profitable, and it is dramatically improving the quality of KKR's earnings. Okay, so how is this playing out in the real world? Well, a huge piece of the puzzle is them tapping into private wealth, basically money from high-net-worth individuals through their K-series funds. And just look at this growth. They've doubled the assets in just 1 year. That is explosive. It's proof that their strategy to reach a whole new class of investors is working, and man, it is happening fast. Okay, that's the model. But the big question is, how does this new, diversified machine hold up in the world we live in now? With higher interest rates, more uncertainty. Let's take a look.
This slide just lays it out perfectly. For their old-school private equity business, yeah, higher rates are a headwind. It makes borrowing money for buyouts more expensive, no doubt. But for their massive private credit business, higher rates are a huge tailwind. Why? Because their loans are floating rate. As rates go up, they just make more money. It's that simple. This diversification acts like a natural hedge against the current rate environment.
And here's a fascinating kind of paradoxical effect. You'd think a tough fundraising environment would hurt everyone, right? Well, it actually helps KKR.
See, when money gets tight, the big investors, the LPs, they don't stop investing. They just get pickier. They concentrate their cash with the biggest, most established names they trust. It's a classic flight to quality that ends up starving the smaller competitors and making giants like KKR even stronger. So, all of this brings us right to the heart of it, the investor's dilemma. We've seen the impressive transformation. Now it's time to weigh the good against the bad, the bull case versus the bear case. Okay, the bull case here is pretty powerful. First, you've got a clear market leader in an industry that's just growing and growing. Second, they've made this incredible shift to stable, recurring fees, which just makes their earnings so much better. They've got multiple growth engines all firing at once: private wealth, credit, infrastructure, and maybe the most compelling point of all, insanely high insider ownership. The people running the show have billions of their own money invested right alongside shareholders. That is exactly what you want to see.
But you got to hear the other side of the story. The bear case is real, and you need to understand it. At the end of the day, KKR is still tied to the health of the economy. A recession would absolutely hurt them. This big push into retail or private wealth, that brings a whole new world of regulatory and liquidity risks. But maybe the biggest hurdle of all is just the valuation. The stock is expensive, which suggests the market is already pricing in a ton of good news, maybe even perfection.
And this table just puts that premium valuation in stark black and white. Look at the PE ratio, the price to book. On both metrics, KKR is trading at a pretty hefty premium compared to its closest peers, Apollo and Carlyle. So what does that mean? It means when you buy KKR stock today, you are paying up for quality. The market knows it's a great company, and those high expectations are already baked right into the stock price. So, we've seen the transformation. We've looked under the hood at the model, we've weighed the risks, and we've checked the price tag. It all boils down to one final question for you, the investor.
Is this incredible transformation, the shift to stable fees, that explosive growth in private wealth, this whole diversified model, is it powerful enough to justify paying that premium price, especially with so much uncertainty in the economy? That, right there, is the core question. It's the whole debate in a nutshell, and now you've got the framework to help you find your own answer.